Now, TOOP TV's been going for a couple of years now, and we know that it's been going for a couple of years because we've got our friends back on, and in a moment I'll introduce one of those. But just so you know, behind the scenes, in between the live bits, it's been very chaotic in here today, and so it's actually been quite funny. But we won't show you the snippets because that's for later on. But on the live show we are here, and joining us in the studio today is the Executive Chairman of Bernie Lewis, Mark Lewis. Welcome, Mark.
Thanks, Anthony. How are you?
Mate, you're coping very well with that. So if people think it's not live, you can
it's
tell them.
It's a flurry of activity in here today, mate.
And speaking of live and speaking of just kind of on the run, what's the market doing?
Look, we're seeing some good signs.
Just before I do,
yeah.
Just in case I sort of almost got a bit flippant about this,
yeah.
But Mark Lewis is the owner of the largest mortgage brokering business in this state. So for those that haven't seen Mark on before, I just thought I'd better let people know that because you deal with a lot of loans, big cross-section of South Australia. So maybe just a very quick size of your portfolio and then let's get into it.
Look, overall, we do mortgages and financial planning now. So our total portfolio, we're managing around about $3 billion worth of mortgages and financial planning and superannuation funds and that sort of thing.
So tick to your credibility.
Yep.
And so now let's talk about the market. Let's go.
Yeah, look, we're seeing some good signs with first home buyers. They're starting to come back into the market after probably a 2-year drought of first home buyers. And you know, as we were saying before this segment, that first home buyers are a really good leading indicator of the health of the market at the moment. And you know, when first home buyers vacate, the market tends to start dropping off. First home buyers coming back, good sign, more activity, and certainly our lending figures are starting to improve. We're seeing investors starting to come back into the market. Obviously property yields are starting to go up because we're getting those rental increases. Prices have come off a little bit last year. They've probably still got a little bit more to come off in some areas.
How much?
Controversial.
Yeah.
Some areas.
Yeah, you're hearing it first here.
You know, we're not talking across the board, but certainly some areas we might see some prices coming off. But hey, you're a better commentator on that. So that will improve yields. So from an investor's point of view, we're going to get back towards that sort of 5% yield in some areas. So that's a good thing. And there's certainly a lot of demand out there for rentals. So you know, with first home buyers, investors coming back into the market, certainly at the lower end of the markets, we're seeing some encouraging signs.
Now, Mark, do you handle much of the middle market and top end? What's your
profile?
Yeah,
a reasonable amount. Look, I mean, as you probably would say, the top end of the market is tough. I mean, if you've got the right property in the right market at the right time with the right buyers, it's going to sell.
Well, there's a shortage, so even though it might be tough, it's actually been pretty strong because there's not much around.
Yeah, true. But I think once you get over that between $1 and $2 mil, sort of $2.5 mil range, it's probably a little tough. Probably back closer to the $1 mil range. That's a tough segment of the market, I reckon, at the moment.
Yeah.
And but certainly down in that market under 500, maybe 550. We're starting to see some good activity in that. Yeah.
Now, we talked off air, and so let's talk on air about the impact of the decision of the Reserve Bank not to move their rates, and then what flowed on from there. Go for it.
Look, I think the Reserve Bank should have moved. I was in that camp. I was firmly in that camp. So I was very surprised that they didn't. You know, I think there was 18 leading economists out there who put their predictions in, and I think 16 of those 18 said interest rates will come down, and I believe they should have. And what we've seen as a result of them not moving is the banks going, well, hang on, we need to move, so we're going to move independently of the Reserve Bank. That has two impacts. Obviously, one is consumer confidence will probably take a little bit of a hit now as a result, which is a shame because the last few months we've started to see some increase in consumer confidence. And the consumer confidence figures are again another good lead indicator of the health of a market. Secondly, the banks moving out of step with the Reserve Bank is just another sign that the banks are almost thumbing their nose at the Reserve Bank. They're sort of saying, well, you know, we're completely detached from Reserve Bank movements. We're going to set our interest rates according to what our needs are. we're not going to let the Reserve Bank say to us when we can raise and lower interest rates.
To me, I read it as the bank saying essentially, we're in control of our own destiny.
Yep.
We're not run by the governor of the Reserve Bank, we're run by our CEO. And to me, that was a huge statement by the bank saying, you know what? You do what you want with the rates, we'll do what we want with the rates.
Exactly, and you know, we probably saw the first signs of that back just before Christmas, when the ANZ came out with its statement that they're now going to review their rates once a month on the second Friday of each month.
Irrespective
of what the Reserve Bank does. So, and you know, the first month they held fire, and the second month I think they held fire, and then of course this month they went 10 basis points or 0.1%. So we're now seeing the other banks following that lead and detaching themselves from the Reserve Bank. So there's probably going to be less hype around what the Reserve Bank does in the future now as a result. So people are going to be, you know, I guess people could get confidence in the past that if the Reserve Bank moved 0.25% either way, then the banks would move accordingly. Yeah. So everyone had their eyes on the Reserve Bank figures each month. We're going to see less of that now. The Reserve Bank is probably, in a sense, from a consumer point of view, going to become increasingly irrelevant as to where their rates are going. People are going to be going, well, what are the banks doing?
So your experience with the banks, do you think that there's less bank bashing now? Do you think people are getting used to it? Or, because you must, in your business, you're seeing people shopping around, or you shop around for them. What's the sentiment? People annoyed, or do they get it, or where's it at?
People are really annoyed at the moment, and that's the thing that we're seeing the most. You know, you've got the banks out there with record profits, and a lot of them did their quarterly announcements, some quarterly, some half-yearly announcements of profits that are, you know, in the billions of dollars. They're laying off staff, and you know, they're not actually, well, most of them aren't physically laying off staff, they're just not filling positions when people leave. But there's still an overall decrease in headcount. They're raising rates to mums and dads, and you notice in all the media articles they're saying they're not making any money out of new loans. Now, a bank can't look at each loan individually and say, well, is that particular loan, is the loan for Anthony TOOP a profitable loan?
Mine would be.
So it's mine probably. But they have to look at their whole portfolios. And some of their, and the way, you know, it's probably take too long to go into the detail of it, but a bank has funding and gets funds from multiple sources. 2/3 of it they get from our domestic, you know, onshore within Australia, and about 1/3 now they get from overseas sources. Yes, the overseas source funding has gone up, you know, the cost of funds has gone up there, but domestically, cost of funds has actually gone down. So across their whole portfolio, they're actually doing all right. But if you actually read the actual words in the articles, they're saying new loans are not profitable. Well, they can't just look at new loans, they have to look at the whole portfolio. So it becomes increasingly hard for the banks to justify on all of those announcements that, you know, they're putting rates up to struggling families. So the negative sentiment is definitely out there at the moment, and I dare say it won't go away anytime soon.
Mark, we'll come back with more in a minute.
Sure.
Now let's go and have a look at some sold properties, the exciting part of the business, gone.